Welcome back, ACCA FM exam candidates. So, today we're tackling an absolutely massive area of your syllabus, equity finance. We're going to break down the exact mechanics of how growing companies actually fund their wildest ambitions and, how they distribute the returns once they make it big. Let's dive right into this explainer.
Because think about it, every single growing business faces this exact same critical dilemma. We need cash to fund our next big leap, right? But where exactly do we find it? And honestly, just as importantly, how do we reward the people who end up providing it? It's really the ultimate balancing act of financial management.
Okay, so here's our roadmap for today. We'll be covering internal equity for fueling growth, external equity for raising capital, rights issues in TERP, going public with an IPO, dividend policy theory, and finally, practical dividend influences.
All right, moving on to Section 1, internal equity and fueling growth.
So we always want to start solving our funding problem with the absolute cheapest source available, which is, well, the company's own pockets. It's kind of like looking at your net income as a giant pie. You can't have your pie and eat it too. To get that internal equity, you literally have to retain your earnings, rather than just paying it all out right away to shareholders. It's this super direct trade-off between fueling tomorrow's growth and handing out today's reward.
Now, while retaining earnings is pretty obvious, right? Here is a little tutor secret for scoring some easy exam marks. Look at working capital. Squeezing efficiency out of your day-to-day operations is actually a massive and honestly often overlooked source of internal cash. Stuff like tighter inventory control or, chasing down your receivables faster, that literally frees up cash to fund your new projects. And the best part, you don't have to ask anyone for a single dime or give away a piece of your company. It's a real game changer.
So, let's jump into Section 2, external equity and raising capital.
Now, what happens when internal efficiency just isn't quite enough? Well, you have to look outside. But this brings up an absolute classic exam trade-off. See, internal funds are super cheap and they keep you totally in control. But external equity? That brings along really high transaction costs and the very serious risk of diluting your current ownership. It's a pretty heavy price to pay for a wider pool of capital, especially if you really aren't keen on suddenly answering to a boardroom full of new bosses.
But let's say you do decide you absolutely must go outside. You basically have 4 major corporate methods for raising that external equity. We're talking rights issues, private placings, public offers, and stock exchange listings, or IPOs. Let's take a closer look at a couple of these.
Let's demystify one of the trickier ones, real quick. Private placings. These are essentially your fast pass to raising cash. Basically, you're selling shares directly to a small, targeted group of institutional investors. Think massive pension funds or big insurance companies. Doing it this way completely skips the exhausting paperwork, all those marketing costs, and the massive regulatory hurdles of a full public offer. It's pretty neat.
Okay, Section 3, rights issues and TERP.
This is a highly testable area, guys. So a rights issue involves offering your existing shareholders the right to buy new shares, usually at a nice discount, in strict proportion to what they already own. And this is incredibly popular. Why? Because it directly rewards your loyal shareholders, and assuming they actually have the cash to buy in, it perfectly protects them from that dilution risk we were just talking about.
Okay, time for a little bit of math. The theoretical X rights price, or TER. Now, I know it sounds super intimidating, but seriously, please don't blindly memorize a complex formula here. Just follow the logic chronologically. Step 1. Calculate the total market value of the existing shares before the issue. Step 2, just add the new cash coming in from the newly issued discounted shares. And finally, Step 3, divide that total value by the total new number of shares. See? You're literally just calculating a weighted average price. It's a piece of cake once you break it down.
But if you want to score full marks on a calculation question, you've got to take it just one step further. Once you have that TRP you just calculated, simply subtract the discounted issue price of the new share. Boom! This super simple equation gives you the standalone monetary value of the right itself, which is awesome because a shareholder could actually sell that right on the open market if they decide they don't want to buy the new shares.
All right, moving on to Section 4, going public, the IPO. So a stock exchange listing, or IPO, this is the big leagues. It's literally the first time you offer shares to the general public out there on an open market. An IPO brings in immense, utterly transformational capital to fuel massive, massive growth. But, and it's a big but, it's definitely not free money. It comes at a very steep cost of intense public scrutiny, huge underwriting fees, and really strict ongoing reporting regulations. The whole shebang.
Now, let's hit Section 5,
Dividend policy theory.
So we've successfully raised all this capital and generated profits, yay us, but how do we reward the investors who backed us? Well, there's a really famous saying, dividends speak louder than words about a company's future prospects. And this right here is the absolute cornerstone of the signaling effect theory. You see, the market is constantly, always looking for clues. Cutting a dividend, that sends investors into an absolute panic. It's honestly like smelling smoke in a crowded theater, it strongly signals trouble. Conversely, confidently increasing your dividend signals supreme management confidence that those strong earnings, yeah, they're here to stay.
And hey, you also have to keep the clientele effect in mind, because investors, they aren't just one big monolith. A retiree, for instance, might really need high cash dividends just to live on month to month, while an investor in a super high tax bracket, they might prefer zero dividends and rely purely on capital growth. So if you suddenly just go and change your dividend policy, you really risk completely alienating the specific clientele of investors that you've deliberately attracted over the years.
All right, our final section, number 6, practical dividend influences.
Theories are wonderful, sure, but out in the wild, financial managers face some pretty harsh real-world constraints. You're generally blocked by 2 major hurdles. First up, legal constraints. You absolutely cannot pay a dividend if you lack the legally required distributable reserves, period. Second is liquidity. Listen, even if your balance sheet looks amazing, if all your cash is tied up in a warehouse full of inventory, you literally lack the physical cash liquidity to write those dividend checks. Remember, profit does not equal cash, and you certainly can't just, mail a literal pallet of inventory to a shareholder and call it a dividend.
So what are the practical solutions when cash is just really tight? Well, you've got 2 excellent alternatives to traditional cash dividends. First, scrip dividends. This is where you offer shares instead of cash. It completely conserves the company's actual cash, all while letting the shareholder increase their total holding. Win-win! Second, share buybacks. This reduces the overall number of shares floating around, which artificially boosts the earnings per share, or EPS, for the remaining investors, often driving the share price right up for a nice capital reward.
Wow, okay, we have covered a tremendous amount of ground today in this explainer, all the way from the quiet, behind-the-scenes efficiency of working capital to the loud, roaring bell of an IPO. As you approach your ACC FM exam, I want you to put yourself in the shoes of a real-world financial director. The ultimate dilemma you face is this: when the time comes for your company's next massive leap, are you going to fund it with internal efficiency or a major external listing? Will you sacrifice your control for cash or sacrifice potential growth for safety? Keep reviewing these concepts, trust your structured knowledge, and absolutely smash that studying. Catch you next time.